What if I told you the exact mathematical signal that triggered the 1980, 2011, and 2025 silver explosions is flashing red right now? While the world is distracted, physical silver is quietly disappearing from global exchanges. Do not click away, because Silver Squeeze 2.0 hasn't just been rumored, it has officially started. Hello everyone, I am John Ag, and welcome back to my channel, The Wealth Reactor. If you want to protect your portfolio and stay ahead of the massive wealth transfers happening right now, please subscribe to my channel and hit the bell icon for the latest updates. Wall Street doesn't want you looking at this. The mainstream media is completely blind to it, too distracted by the daily swings of the stock market. But the math behind the scenes is flashing a massive warning sign. If you hold physical silver, or if you have been waiting on the sidelines for the perfect entry point, you need to pull up a chair and pay close attention. We are officially issuing a silver alert. Let's dive right into the data. Let us start with part 1, the mathematical silver alert, GSR breakdown, and market analysis. The silver alert I am talking about is the gold to silver ratio, or the GSR. This is the classic, time-tested indicator that catches the eye of institutional investors, hedge funds, and deep-pocketed whales. It simply measures how many ounces of silver it takes to buy 1 single ounce of gold. Historically, extreme highs in this ratio have preceded major, violent, and wealth-generating silver bull runs. Right now, in late April 2026, the ratio is hovering near 75 to 1. Let me put that into context for you. The modern historical average sits between 50 to 1 and 65 to 1. During the Roman Empire, the ratio was legally set at 12 to 1. In the early days of the United States, it was 15 to 1. But if you look at the physical mining ratio today, the actual geological rate at which these metals come out of the earth, we only mine about 8 ounces of silver for every 1 ounce of gold. Yet, the financial paper markets have currently priced silver at a massive artificial discount of 75 to 1. When the ratio sits at these elevated levels, while gold is trading at near all-time highs of around $4,959 an ounce, it means silver is mathematically and historically cheap. It is like buying a high-performance sports car at a used sedan price. In every major bull run, silver violently outperformed gold to close this gap. Think back to the Hunt Brothers squeeze in 1980, when silver rocketed to $50 an ounce. Think back to 2011, when the Federal Reserve's quantitative easing drove silver right back to that $50 level. And think back to our recent 2025 run. In all these events, the ratio collapsed, meaning silver's percentage gains absolutely crushed gold's gains. Right now, silver is sitting at $79.50. It is currently consolidating after that massive parabolic breakout we saw back in January when it hit over $120. The rising ratio right now suggests silver is temporarily lagging behind gold as it catches its breath. Institutional algorithms track this ratio closely. They know that when the rubber band stretches this far, it always snaps back. And that snapback is your window of opportunity. The math dictates that silver must rise significantly just to return to its historic baseline with gold. Moving on to part 2, global macro shifts, BRICS de-dollarization, and the Wall Street pivot. We have to look at the macro backdrop because world news is accelerating this squeeze at an unprecedented rate. We are seeing continued Middle East energy shocks driving up the cost of oil and natural gas. You have to remember that mining, extracting, and refining silver is incredibly energy intensive. It requires massive diesel machinery and power-hungry smelting plants. When global energy prices surge, the baseline cost of producing a single ounce of silver skyrockets. This puts a rock-solid, unbreakable floor under precious metal prices. Miners simply will not sell below their cost of production. Meanwhile, the global geopolitical landscape is fracturing in real time. The BRICS nations, led by China, Russia, India, and now joined by major energy producers like Saudi Arabia and the United Arab Emirates, are continuing their relentless de-dollarization strategy. For decades, the global system relied on the petrodollar. You had to buy oil with US dollars. That is changing. These nations are dumping US treasuries, settling trade in local currencies, and aggressively hoarding physical metals at a record pace to back their own financial systems. They understand the golden rule. He who holds the gold and the silver makes the rules. This dynamic is draining Western vaults and creating a one-way street for physical bullion moving from the West to the East. Wall Street is finally waking up to this reality. Major market bulls and commodity analysts from top-tier banks are quietly but aggressively revising their price targets upward. They are looking at the persistent, sticky inflation data. They are realizing that fiat currency is bleeding purchasing power much faster than the official consumer price index numbers admit. The Federal Reserve is trapped. If they raise rates to fight inflation, they crash the debt-burdened economy. If they lower rates, inflation runs completely out of control. Because of this trap, the smart money is moving out of overvalued, top-heavy tech equities and rotating heavily into hard assets. Hedge fund managers who previously laughed at physical commodities are now setting up massive positions in silver exchange-traded funds and mining stocks. They know a sovereign debt crisis is brewing, and physical silver is one of the only true safe havens left on the board that still has massive upside potential. This brings us to part 3, the supply shock squeeze, the Shanghai exchange, and AI infrastructure. Beyond the charts and the macro news, bulls are incredibly excited right now because 3 massive structural supply indicators are converging all at once. This is the perfect storm. First, the Silver Institute just confirmed that 2026 is the 6th consecutive year where global silver demand completely eclipses supply. Let that sink in. For 6 years, we have been mining less silver than the world consumes. We are eating into above-ground stockpiles at a terrifying rate. Why? The absolute explosion of artificial intelligence infrastructure, the electric vehicle revolution, and global solar panel manufacturing. Let us break that down. AI data centers run incredibly hot and require massive amounts of energy and sophisticated hardware. Silver is the most conductive element on Earth, making it absolutely irreplaceable for high-end microchips, electrical contacts, and thermal cooling systems. Furthermore, the solar industry has shifted to what is called N-type solar cell technology. These new, more efficient solar panels require anywhere from 50 to 100% more physical silver per panel than the older models. Big tech and the green energy sector need silver to survive, and their demand is completely price inelastic. They have to pay whatever the market demands, even if silver hits $200 an ounce. They cannot substitute it. Second, and this is the catalyst nobody in the mainstream media is talking about, in mid-April, the Shanghai Futures Exchange had to issue emergency halts on silver trading. The official reason given was physical inventory depletion. Let me translate that into plain English for you. They are running out of real physical silver to deliver to buyers. For years, the paper market has traded hundreds of paper contracts for every 1 real ounce of silver in the vault. But now, industrial buyers and sovereign nations are calling their bluff. Traders are demanding physical metal, not paper contracts, and the vaults are emptying. This is sparking legitimate fears of a global short squeeze as arbitrage traders frantically try to pull metal from the COMEX in New York to cover massive physical shortages in Asia. Third, both the United States and China have officially reclassified silver as a critical mineral. It is no longer viewed as just a monetary precious metal or something used for jewelry. It is vital to national security and next-generation defense technologies. Missiles, satellites, and radar systems cannot function without silver. This government reclassification threatens to severely limit future export supplies, as superpowers will likely begin hoarding it for their own strategic reserves, taking even more supply off the open market. Finally, we must look at Part 4, technical market analysis, overbought warnings, and the bear case. Now, as always, here on the Wealth Reactor, I have to be completely honest with you. I am not here to just feed you hopium. Not everyone on the street is screaming buy, and you must understand the bear case so you do not get shaken out of your position during a sudden violent price drop. Some technical analysts are warning that the market is showing toppy, exhausted momentum in the short term. If you look at the Relative Strength Index, or RSI, on the daily and 4-hour timeframes, silver is currently flashing warning signs in overbought territory. When the RSI gets this high, a cool-down period or a period of sideways consolidation is almost always required before the asset can move higher. Furthermore, silver is currently battling a massive psychological brick wall of resistance at the $80 mark. Every time the price approaches $80, the bullion banks and paper short sellers flood the market with millions of paper contracts to knock the price back down and trigger stop losses. There is also a broader macroeconomic risk you must be aware of. If we see geopolitical de-escalation, specifically if the current global ceasefire talks progress and bring stability to the Middle East and Eastern Europe, it will pull the fear and war premium right out of the market. investors might briefly pivot back into risk-on assets like stocks. Additionally, we have to look at the threat of a broader stock market liquidity crash. In 2008 and again in March of 2020, when the stock market crashed, silver plummeted initially alongside it. Why? Because institutional investors were hit with massive margin calls. They were forced to sell their winning assets like gold and silver just to raise cash to cover their losing stock positions. If we see a sudden liquidity event in 2026, history could repeat itself. If any of these bearish triggers happen, we could see a short-term mean reversion. Do not be surprised if we see a violent, rapid pullback toward the $70 mark, or even down to $65 to test historical moving averages. But you must understand this critical point. A pullback of that size is actually incredibly healthy. It shakes out the weak hands, punishes the over-leveraged traders, and builds a much stronger concrete foundation for the next explosive leg up. So what is the final verdict, and what should your strategy be? The silver alert is flashing because silver is fundamentally, mathematically, and historically undervalued relative to gold's record-breaking run. Yes, we are battling extreme volatility. Yes, we are facing heavy resistance at $80. But make no mistake, the physical shortage is entirely real. The industrial demand from artificial intelligence and solar energy is inelastic, and the financial institutions are panicking behind closed doors as the East drains the West of its physical metal. The fundamentals suggest the second leg of this bull run is entirely possible, if not mathematically inevitable. If you are a retail investor, the strategy is patience and persistence. Trying to time the exact bottom or top is a fool's errand. Instead, many successful investors use dollar-cost averaging, buying a set dollar amount of physical silver every month regardless of the daily price fluctuations. If you are buying paper silver, make sure you understand the difference between unallocated ETF shares and fully allocated, fully backed trusts. Physical metal in your own possession carries zero counterparty risk. When the financial system shakes, counterparty risk is the single most important thing you want to avoid. The window of opportunity is open right now, but it will not stay open forever. Once the mainstream retail crowd figures out what is happening, the supply will vanish overnight, and the premiums on physical coins and bars will skyrocket to levels we have never seen before. Are you currently holding physical silver, or are you waiting for a potential pullback to the $70 range to load up your bags? Are you buying coins, bars, or mining stocks? Let me know your exact strategy in the comments down below. I read as many as I can, and I love hearing how the Wealth Reactor community is positioning themselves for this wealth transfer. Once again, I am John Agg. Thank you so much for tuning in to the Wealth Reactor. Your support means the world to me. Please make sure to hit that subscribe button, smash the like button for the YouTube algorithm, and turn on the bell icon so you never miss an urgent market alert. Stay safe, stay prepared, and I will see you in the next video.